Nick is going to be our moderator, so I will let you take it away.
Thank you, Melissa, and good morning, everyone. Welcome. So real quick, Melissa's right. I am seasoned, maybe a little over seasoned. My my experience in the markets goes back to the beginning of my career. I began my career in New York. I am a North Carolina native, and in fact, I'm from Wilmington originally. Been living in Charlotte most of my life. Raised a family here, but started my career right out of school, right out of undergraduate school in New York with Barclays Bank, and went through the training program there to become a trader. Barclays Bank, of course, is a UK-based entity. Spent a few years there, then spent some time with Bank of America for about 10 years, where I really cut my teeth as a trader in FX and other parts of the fixed income markets. Then moved on to what ultimately became Wells Fargo through the First Union Wachovia channel. That's how I ended up in Charlotte and back in Charlotte, my home state. And retired after 36 years from the banking world in 2018, and was fortunate enough to be introduced via one of my corporate clients in Houston. And by the way, I've covered in that period of time in my banking world, covered companies. And by the way, doing Forex, which is exactly what we're going to be talking about for those institutions, covered companies all over the world. And all over the United States as well, in multiple sectors, primarily energy, oil field services, manufacturing, distribution, financial institutions, insurance, and then was lucky enough to meet the folks with Marc and others in 2000. Joined the firm in 2019 as a partner. I'll let Marc talk a little bit about that, but by 2020 we were purchased, so we were no longer private, and we are now a much larger institution with a much larger capital base than where we were as a private partnership, and just growing leaps and bounds and continuing to cover and expanding our markets. Our target market is, and I'll let Marc talk a little bit more about that too. Our target market is the middle market and the upper middle market. And when we say that, we're talking about anything from 20 to 30 million in revenues, upwards of $1.5 billion to 2 billion. So that's a large swath. But as we've with my friend and client Scott, we also deal a lot with much larger companies for liquidity purposes and to provide services there. They assist us with the size trades that they do in becoming more of a liquidity provider for the middle market and a better and more efficient. And I'll talk about that later. However, that's me. Marc, why don't you tell us a little bit about yourself?
Sure. Thanks, Melissa. Thanks, Nick. So my name is Marc Chandler. I've spent my career basically in a couple of functions. They're all the same skill set. It's really like analyzing and thinking about the global capital markets. And by that, I mean currencies and interest rates. I follow the equity markets only in terms of how they affect global capital flows. I think that we all get to our points in our careers different ways, and I think that trying to help other people navigate these markets. When I bought this suit jacket, I knew that I was paying a retail price, and I knew whoever I was buying it from paid a wholesale price. And money works that same way, but we don't think about it like that. The banks charge each other. What banks charge each other is the wholesale price for money. It's about 5%, 4.75% to 5% now. That's the wholesale price for money. The retail price for money is what my credit card wants to charge me, over 20%. Currencies, interest rates, almost anything that we do as small, medium-sized businesses, we often find we're paying retail prices as opposed to wholesale prices. And I like the idea of arbitraging, of bringing what's been institutional quality, information, prices, efficiency, bring those to small and retail, small clients, small businesses, And I think that just works on the flow of information as well. I have a blog. I post commentary publicly available at a blog called Marc the Market, Marc with a C, makes my mom happy. And so I try to, besides writing for the bank and talking with clients, I try to contribute to the industry associations. I often, maybe once a month, once every other month, I'm writing an article in Barron's. I'll boost a profile for Bannockburn. And I'll leave it at that. But I think we'll look coming back to these issues about how we at Bannockburn try to help small and medium-sized businesses close that gap between wholesale and retail. Scott?
Sure, yeah. So good morning, everyone. Scott Chinn. I work at MFS, Massachusetts Financial Services, as we used to be called. We are a global asset manager based out of Boston, but we have a number of offices in Canada, London, Japan, Latin America, a lot of EMEA as well. And so we do a fair amount of currency trading to kind of support those offices. So I've been with the firm for well, it's scary to say, a little over 20 years. And so in this capacity as corporate treasurer for the firm, and we do a lot in the ways, like I said, of FX trading for spot trading. We also do a fair amount of hedging as well for some of our products that we have incubated in the firm. We have about 640 billion in assets under management, and so we have that spread across a wide range of products, probably about 30% institutional and 70% retail, and that retail is heavily in the U.S. as well as in the European markets as well. So with that, I can toss it back to Nick.
Thank you, Scott. I don't know if you mentioned, but Scott is the vice president and global treasurer for MFS. And we've been working together for many years and been happy to do so. At this time, I want to reintroduce Marc, Marc Chandler, our political economist, and to mention a little bit, Marc, give us a sense of what's happening, what we can expect with all the recent developments, geopolitical, political, and otherwise, monetary, Fed related. Please tell us what's going on.
Sure, yeah, so that's what we'll do, right? So I'll just speak for 10, 15 minutes and try to help give you a big picture overview of what's going on in the world. And then Scott and Nick will drill down and really talk about where the rubber hits the road, how people are using the foreign exchange market, like Scott, how are they doing it? How are they thinking about it? How are they managing their risk and exposure? So let me begin off just with a broad perspective on the economy. The first thing I'd want to say is that I know we just had this fiercely partisan election and a lot of debate about the economy. And of course, our own individual position, our own individual situation varies, of course, where we are. But broadly speaking, we are living through a moment that may be comparable to the time when the Berlin Wall fell and the Soviet Union collapsed. We are at a point of, it's popular to talk about American exceptionalism. But it's not just exceptionalism. I mean, it's economics of it. And I want to show you just a little bit about what that means. But first, let's just talk about the very near term, like just that little space in the next week or 2 weeks. On Friday is the most important single piece of economic news that the U.S. generates, and that's the jobs report. That's Friday. It comes out typically the first Friday of every month, 8:30 here on the East Coast. And the reason the jobs number is so important is that it's the first number of the new month, and from that number, economists can tell a lot of different things. If you know how many people are working, you have an idea about what income is. And if you know what income is, you multiply it by about 2%, and now you got what consumption is. And so you get, if you know how many people are working in manufacturing, how many more people are working in manufacturing, you can forecast industrial production. So the jobs number is probably the single most important number right now in this cycle. The Federal Reserve, as you know, has two mandates: full employment and stable prices. The Federal Reserve thinks it's close to achieving its stable price mandate, so it's spending more time concerned about the employment mandate. And we have seen some slowing of the labor market. But Friday's jobs number should be strong. We've had some weakness, partly distorted by the weather, some strikes. The initial estimate for Friday's jobs number, and this is how many new jobs the U.S. economy is creating, is about 200,000. And put that in perspective for you, that's a bit above what's average for the really for this year. So stronger than average jobs number on Friday. Then, in the middle of next week, we're going to get the CPI. That's the Consumer Price Index. That the Federal Reserve does not target it, but once you know the CPI, the Consumer Price Index, you have a very good sense of the inflation measure the Fed targets, called the PCE, Personal Consumption Expenditure Inflator. That typically comes out towards the end of the month. CPI comes out first, and so the market uses it, and people put it in their models and react as if, based on the CPI, they can forecast what the PCE deflator is going to be. Inflation looks like it might have ticked up for the second month in a row. So here's where we are. The Federal Reserve cut rates by 50 basis points in September to begin the easing cycle. And then they cut 25 basis points earlier this month, 2 days after the election. The issue is, what will the Federal Reserve do in December? They meet on the 18th. It looks like many people are still leaning towards a rate cut, another cut by the Fed. I think that after that jobs data on Friday and the CPI on Wednesday next week, that the Federal Reserve may have second thoughts about it, and the market might not be as confident. And that's really one of the points to really take away from this is, who really knows what's going to happen? We don't live in a world of certainty. We live in a world of probabilities, probabilistic world. And so we have some ideas about odds. For example, the market right now is pricing in about a 50% chance that the Fed the Fed cuts rates later this month. I think those odds are going to slim, but it's really a question of probability. What are the odds of something taking place? And so when I say the U.S. economy is growing so well, or doing so well compared to the rest of the world, here's what I mean. And this was one of the good predictors for how people are going to vote in the U.S. election. If you were in a county that per capita GDP was lower than it was before the pandemic, you likely voted Republican. And you could understand what makes sense, right? Your family are not living as well as you did 5 years ago. And so what we did was we punished the incumbents. And this is not just in the US, by the way, but incumbents in almost every other country had elections this year also saw the incumbents lose. But since 2019, the US economy as a whole has grown 11.4%. And the key to this, I want to suggest to you, is two things. One of them is us, people. Labor productivity is up 30% since the great financial crisis in 08 and 09. So if you were making 100 widgets before the great financial crisis, you're making 130 now. Productivity has gone up. And this is really how the US outshines the world. To give you a sense, Europe, that's the Eurozone, continental Europe, and the UK, their productivity has grown by about 10%, 1/3 of ours. So when we think about corporate earnings, we think about where to invest money, we think about where to build a new business or to build a branch of an existing business. The US economy is just growing gangbusters over other countries. And it's because of this productivity. But the other reason why the US economy is shining is that we, Americans, are willing to spend as much money as it takes. By that, I mean the US runs a huge budget deficit. Put this in perspective for you. Last year, the budget deficit was about 6.3% of GDP. This year, about 6.5% of GDP. In the next 2 years, the IMF said it's going to still be above 6%. Put this in perspective for you. Europe wants to reduce their budget deficits to 3%. They probably won't make it there. Many countries won't make it there, but some countries will. But it just gives you the sense that here in the US, we're talking about tax cuts. And in Europe, they're talking about tax increases. They're talking about austerity to reduce the budget deficit, even if they don't get it down as far as they'd like. You still have austerity there, while we don't have austerity here in the US. Now, where you can follow what the Federal Reserve thinks the way its projections are, which doesn't necessarily have the political axis that, say, bank economists might, they publish something quarterly called a Summary of Economic Projections. Summary of Economic Projections. The Federal Reserve goes through this exercise every quarter, and they update, so they do a survey of themselves. And what they give us is the range of forecasts and the median. And this becomes a very useful guide. The Federal Reserve is telling us what they think they're going to do with interest rates, where they think the economy is going. So when the economy deviates from that, it means there's a surprise for policymakers, and they'll respond accordingly. It's not just that the US is doing well. Productivity, a large budget deficit, but the rest of the world is doing poorly. Germany and France are the largest economies in the Eurozone. Both of their governments are collapsing. Germany will likely have a vote of confidence about their government. It's going to lose in the middle of this month. France could have a vote of confidence as early as tomorrow. And just at that moment in time, we passed the U.S. election. We'll have a new president in January. Europe is shooting themselves in the foot. Not only haven't they grown much, but their political problems creating like its paralysis at a very important historical juncture. And what's happening then, and this is why I think that just bring this back a little bit to what this means for the markets, is that the dollar is very strong. Partly the dollar is strong, not just, like I say, it's a reflection of all these macroeconomic factors and inertia. The dollar's in an uptrend, and what's it going to take to break this uptrend? And this is a real problem for American exporters, which is partly why we run almost $100 billion a month trade deficit. The US dollar is very strong. When it comes to the price of an equity, there's agreed upon models, how to figure it out. How to figure out fair value, whether it's free cash flow, breakup value, replacement cost, assorted models. But currencies, my crypto friends are right, are not backed by gold or silver. It's very hard to determine valuation. Economists have come up with a measure. It's a bit like boxing. They talk about how the fighter is, how strong they are pound for pound. So a big boxer compared to a small boxer, the small boxer might be stronger given their weight, how much weight they can lift, basically, right? They can lift 10 times their weight. There's an ant that can lift 5 times their weight. So in wrestling and fighting, people call it pound for pound. In the capital markets, the currency markets, we call it purchasing power parity. The Economist magazine looks at a price of a Big Mac and say that the price of a Big Mac, an internationally traded basket of goods, should sell for the same price around the world. To the extent it doesn't, shows a currency misalignment. What I'm interested in is not so much the Big Mac, it's too simple and too small, but I want to have a bigger picture of this traded goods. The Organization of Economic Cooperation and Development, it's about 26 high-income countries that form a club. They have their own model of purchasing power parity. Usually, the G10 currencies don't deviate much more than plus or minus 20% from fair value. Today, as we sit here, the euro and the yen are more than 55% undervalued. Sterling is a bit more than 20% undervalued, as is the Canadian dollar. I just give you that just to give you a sense of probably just confirming what you already suspect. And if you're exporting, you've been facing a very powerful headwind. The dollar is not as competitive as it could be. The challenge, though, I think, is going to be that the kind of forces that are at work in Europe, the US, and in Japan probably means the dollar is going to be stronger for longer. The euro made a low of about 95 cents back in 2022 when sterling and Europe was in another type of crisis. I think that's where we're probably headed back to. The euro today is about $1.05. So I'm suggesting to you that in the next 6 months, 9 months, we probably will be down another a dime or so, about 10%. And that's probably true, broadly speaking, for most of the major currencies. Many people think, and this was even before the election, that regardless of how the election was going to turn out, both candidates did not really focus on the fiscal deficit. Because they're going to have fiscal deficits, maybe larger fiscal deficits, as people are worried, it's going to fuel inflation. It's going to keep the Federal Reserve from cutting rates as much as other countries, which is going to lead to a stronger dollar. And this, of course, was all before Germany and France shot themselves in the foot. So broadly speaking, the news is the U.S. economy is growing. I do expect it to slow probably in the second half of next year. The dollar is strong. The Federal Reserve is likely, I suspect, to pause in December. The market is pricing in 75 basis points of hikes next year from the Federal Reserve. Excuse me, 75 basis points of cuts. 25 here in December and another 75 next year. In the summary of economic projections by the Federal Reserve, last one was in September. The next one will be when the Fed meets. In September, the Federal Reserve said they'd cut 100 basis points this year. And of course, we've had, they sort of have this right to change their mind as incoming data changes. And I suspect that they will change their mind when we get the December summary of economic projections called the dot plot. And I would look for the Federal Reserve to reduce the number of cuts next year from 100 to 75, converging to where the market's at. So I hope this gives you a broad picture. I know some of you, some questions were about some currencies that aren't traded as liquidly. And that's really what we find is that part of the role of the dollar in the U.S., in the world economy, is that countries that don't have liquid currencies or accessible currencies because of domestic rules and regulations, the market, those exporters from that country, Bolivia, South Korea, Taiwan, they will often use the U.S. dollar. When Australia sells iron ore to China, they're invoicing in U.S. dollars. When Saudi Arabia sells oil, they're selling their oil in dollars. So the dollar's role in the world economy remains superior. Partly, I'd say, inertia. There's no convincing rival. I know, it's sort of like our keyboards. We all use the same keyboard, QWERTY. I'm told that there's better, more ergonomically, better designed keyboards. So what? It's got to be not just marginally better. It's got to be a lot better for me, this old dog, to learn a new trick, to learn a new keyboard. And I think that's the same way with foreign exchange. You know, there's this language that they made up many years ago called Esperanto. It was supposed to be a universal language. Hardly anybody speaks it. And I think that's really speaks to the natural order of things, sort of the natural evolution. Of course, there were other primary currencies before the dollar. And I'm sure in human history, there'll be other primary currencies besides the US dollar. Just like there was an asteroid, a huge asteroid that hit Earth a millennium ago. There'll probably be another one. Maybe not in our lifetime. I think the same thing about the dollar. So with that, thank you very much for your time. But this is really, we're going to get to the meat of the presentation now as Scott and Nick talk about where the rubber hits the road, how people like Scott treasure and think about and manage his currency risk. Good luck, guys.
Thanks, Mark. Thanks for those comments. The foreign exchange market, let's just talk a little bit about that, and I'm going to let Scott chime in here. But what is we know it is a foreign exchange market, sometimes referred to as the FX markets. A lot of people realize this, others don't, but the Forex market is essential to most companies nowadays, following 30 years or so of globalization, almost entirely. It almost touches every market, not just those that are trading overseas or doing business overseas, but domestic companies here in the U.S. who may be sourcing equipment or sourcing components for products and on the manufacturing side and distribution. What Mark didn't mention is we're also commodities traders as well for the commercial sector. So oftentimes you've got distribution companies with fuel costs that need to be managed. So FX and the part of the capital markets that we work in kind of touch everybody. In the case of a company as large as, say, Scott's, for instance, it's a much broader, with offices in other parts of the world, it's a more obvious need. But just so you know, as Mark touched on this is a service that all large banks offer to their clients. Unfortunately, in the full scope of service with advisory and analytics like we provide, they limit that because of bandwidth issues to the larger companies, the ones that have a higher credit quality, those that they have visibility to, like Scott's company, for instance, which is publicly traded. We try to bring, as Mark pointed out, that service to the middle market. And it's companies like Scott's who help us do that in a very efficient way, because the volume of currencies that a company like Scott's trades in the hundreds of millions of dollars, we're able to be a liquidity provider to them. And when we take that volume and with Scott's companies and other large multinationals that we work with, when we bring that volume to our traders are then able to offer, as Mark pointed out, more efficient pricing to smaller companies. Now, this is something that our bank competitors don't spend a lot of time doing. They're obviously liquidity providers, and we need to go to them oftentimes, to the larger banks like the Deutsche Banks, the Goldmans, and the JP Morgans to gain liquidity in the market. But we come as a large player. We come as a wholesaler to them, as Mark pointed out. And we try to close that gap between the wholesaler and the retailer, as Mark pointed out. Just to give you guys a sense of how large the foreign exchange or the FX market is, in a 24-hour cycle, and by the way, this is a 24-hour market, 5 days a week. It opens on Sunday night in Asia, which is Monday there, and it closes here in the U.S. on Friday afternoon. Every 24 hours, over $7 trillion are traded every 24 hours. That's the volume in the Forex markets, just to give you some sense of size and scope. That dwarfs every other financial market, in many cases, put together in terms of volume, the kind of volume that you would see, say, in the global equity markets or the global bond markets or other debt markets. So it is a huge market. And if we go back to my days and Mark's as well, when we entered the business back in the 80s, that number, and Mark, correct me if I'm wrong, but if I remember correctly, it was about, I think it was less than 200 billion, maybe even less than 100 billion daily in that market. And then at that time, the participants in the market, which I want to talk about, like who uses this market, the participants were pretty evenly split between manufacturers, real FX users like Scott's company, who needs it for their internal operations, to fund their different businesses all over the world. It was split between them and institutional players, the central banks and the money centers and the hedge funds of the time. Today, at almost 7 trillion a day, I think it's over 70 to 80% of that market is institutional now. And those are folks that are typically profiting from the market. And as I think someone asked the question about algorithm and bots trading, well, that's where it's going. I don't know that we were very different than bots back in the 80s and 90s when we had to do it yelling and screaming in the market. We were passing on information that it could have easily been passed on, and making decisions that could have very basic decisions, really, when you think about it, and trends, they could have been made by computers far more efficiently than we were doing it. And obviously today that's happening. You walk into a trading room today, you can hear a pin drop. You walked into a trading room in the 1980s or 1990s, you couldn't hear yourself think. So there's a big difference in how things are being done and how much more efficiently. What we try to do, however, in the market being so large and so institutional, we want to bring the businesses of not just North Carolina, all over the United States and worldwide, those who want to work with us that are smaller in size, we want to make that process more efficient for them, so they can reap some of the same benefits that larger companies are reaping from working with larger banks as advisors and as analytics. So having said that, we do provide advisory work and analytics to these companies and to companies like Scott's where it's needed. So there are a lot of the participants, as I've mentioned, trade foreign exchange for profit. We primarily work with companies that are trading foreign exchange to manage their operations because they have embedded foreign exchange risk. It's embedded in what they're doing. Whether they've got an operation, they've got a vendor that they've recently purchased or are looking to purchase in Germany, we help sort of smooth out that risk, so they can price so that they're getting efficient pricing on their acquisition. Or let's say they own the company. It's on their it's an investment of theirs. Well, they have to mark that investment to market because it's euro based, it's euro denominated, and they're a U.S. denominated company. They've got to mark to market that company every quarter or once or twice a year or whatever it is. That's risk. They're buying capital expenditures from overseas. A manufacturer that doesn't even sell overseas, or maybe just sells to Canada or Mexico, that's based here in the U.S. or in Canada or in Mexico, has machinery being made in Belgium or in Italy or in Japan or in Korea. There is risk there. Components. I'm going to let Scott talk a little bit more about the things that he manages. But why are we different then? If we're doing what the banks are doing we're doing it for the middle market and the upper middle market target, as well as the large companies. Why are we different than our competitors? And Marc and I talked about this. We talk about this a lot, and we like to think of ourselves, Bannockburn Global Forex, that we really focus on aligning our needs together with those of our clients, and we can do that because we're smaller. We punch way above our weight. Our capitalization is pretty large for the size company that we are. It's pretty large, and you can look us up. But at the same time, what motivates us to what helps what motivates us and what benefits us is what benefits our clients, and that's something that you typically don't find in the business. Because as Marc pointed out, you have small pools of capital in the Forex markets, and that's what middle market companies are. You think about a $5 million exposure to a $50 million company, that's a lot of money. That's a lot of exposure to the Forex markets. To the actual market itself, that's tiny. So that's where we step in, and companies like Scott's help us because they provide volume for us to make the pricing more transparency when we price our middle market clients. Smaller pools of capital get charged larger margins and spreads, and larger pools of capital are charged typically in the market smaller spreads. We try to close that gap, as Marc pointed out. So that's essentially who we are and what we do and what the markets do. Scott, why don't you tell us a little bit about just if you could break it down into like major sectors of what you're doing. You mentioned earlier, but talk a little bit about, if you would, just tell us about your experiences in the market and if anything that I've said or that Marc has said, if you agree or disagree or would like to add to it.
Yeah, sure. So like I said, we're a global financial services firm. We have, like I said, 640 billion under assets, and there are kind of two parts to it where we are obviously trying to make sure that we have sufficient liquidity for our operations across the globe, whether that's in Australia, in Canada, Japan, and London. Having visibility into those offices, knowing what they need for operations and making sure that they have the funding available to make sure they can make rent, they can make payroll, and all that sort of stuff. And so for that, we're going into the FX markets, doing spot trades, and kind of trying to forecast when we might need those funds. And conversely, when we do also have income revenue coming in those various jurisdictions, we're a U.S.-based company at the end of the day, and so our P&L, our balance sheet is all going to be based in U.S. dollars, and so I try to limit that exposure to non-U.S. as best I can, whether it's just daily monitoring of where our balances are going or forecasted to go, and then working with our partners like Bannock to help us then hedge some of that risk and take some of the risk off the table. Now, there's a secondary part to this role as well in terms of FX management, and that's with our seed investment portfolio. And so as an asset manager, our products are really our services and how we kind of market those services to our clients and manage their capital and funds. And so, where certain companies may be selling products globally, we are trading assets, and those assets are going to be denominated in foreign currencies as well, right? We're not just trading on the U.S. exchange, but we're also trading on the Asian exchanges, on the European exchanges. And so in order to do that, there's going to be an FX component to do that, to kind of settle that trade, if you will. And so all those various securities and assets will have present an FX exposure to us. And part of my role is also to mitigate that risk and hedge that risk away. And so we do have a process, and this is kind of unique to our role, but I think it applies probably to any company that has assets that are denominated in other currencies, whether it's a vendor invoice that you're going to pay out, a liability, or if you have revenue that's coming in, sales that are being done outside the U.S. And those receivables are going to be coming in, and maybe that's being billed in non-U.S. currencies, or you want to hedge that risk away as well. So I think it applies, and the way that we look at it as a kind of a global exposure portfolio of currencies, if you will, and we have tools kind of internally that helps us optimize those global exposures down to maybe a set of 4 or 5 currencies to help us mitigate their risk. But I think where we've also leveraged our banking partners to help us do some of that work is we can provide that exposure profile to them, assuming we have a good data, and they can do that for us. They can go into their systems, look at how those currency trends have paired against the U.S. dollar, and help you kind of come up with a hedge portfolio, if you will, that matches what your unique exposure profile looks like. And so I tried to work with our banking partners to help us do some of those sort of things. And a partner like Bannock can certainly has the capabilities and the tools to help formulate that for us and put that all together. We tend to hedge in increments of 3 months, so we'll do 3-month forwards in various currencies back to the U.S. dollar to help us mitigate that risk of seed investments, and then we'll look at it every quarter and reevaluate. Or if we're launching new products, or maybe we're closing down or pulling back seed investments from successful product launches, we'll take that into account as well and kind of re-augment the hedge position. Doing that whole exercise again, where we kind of look into our underlying pool of assets, come up with a new currency exposure profile of what it looks like around the globe, and then we'll have that file kind of looked at and evaluated again, and help have the banking provide us new hedge profiles that we'll then execute again for the following quarter. So this is kind of like a rolling process that we do every 3 months or so. That it can range between 100 to up to 300 million in trades that are happening every quarter, and sometimes we're adjusting within the quarter as well based on where equity markets are going. As you can imagine, the equity markets can move a lot quicker, and so we want to make sure that our currency exposures are kind of matched up with those exposures as well. So, like I said, we'll do that we'll do those forward trades quarterly. And then, like I said, going back to the kind of the operations, the spot trades, we do kind of more frequently throughout the month, maybe 4 or 5 times in a month, or sometimes you're doing it 2 to 3 times a week. And having good contacts and partnerships with firms like Bannock and your other banks where, quite honestly, we find that there is a higher touch point with I mean, I guess I don't want to call you guys a boutique firm anymore, given that you guys have been acquired by a larger bank, but you still have that nice feel where you're talking to someone, and if it's a very important trade where we need to have settlement kind of followed through and not just fed through a system, having folks on the other end of the line and not just kind of keying it into a bank system is certainly very helpful. Those tools do serve a purpose, I feel like, especially when you want to get pricing for what's going on in the market. If you don't have access to a terminal like a Bloomberg, but having that person on the other line is actually nice to have, and a bit old school, but it adds a little bit of comfort when you're moving large amounts of money, especially when it's a self-proprieted business too. I'm sure it adds some more comfort there as well.
Yep.
So
thanks, Mark.
I can stop there, and we can.
I have a couple questions that I could kind of pepper in. I'm just kind of thinking for those of us that are working with small to medium-sized businesses on the regular, two questions for the panel. First off, would you be able to provide kind of just a mini case study, an example of a smaller company that you've worked with for the first time, what that transaction looked like? What did the conversation look like? Was it machinery that was being bought from Europe or Asia? And tell us about just baseline, what to expect from that first conversation, things to consider. And then my second question has to do with what Scott was just mentioning, that there are these various touch points. It could be more frequent if it's a spot situation, or those 3 month duration commitments. What would a small to medium sized company need to have staffing wise to be able to support being that person that interacts with Nick's team or someone else that is essential for maintaining those relationships? So again, my first one was, can you give us an example of a first time interaction? Second question is, what is really needed to be able to start and maintain this type of relationship?
Those are very good questions. Thank you, Melissa. Scott, can I ask you to maybe chime in on the second question about the operational aspect of it, to elaborate on that some, and I'll attack the first question.
Yeah, sure. So I think being able, the staffing that's involved to do some of this sort of stuff really depends on your volume, right? And I think a lot of it also is how much you can do internally versus how much you want to have a partner help you out and kind of help you mitigate some of the risk, whether you're hedging or you're just kind of monitoring and managing your cash flows. So I don't think it's a heavy lift in terms of interfacing with your partner, your trading partner. That's like a one person job, but I think you also want to make sure that at the end of the day you have proper controls, right? And so if you're having one person do the trading, you want to have another person that's doing kind of the confirming, if you will, making sure that the cash flows match up with what the actual trade was and the cash is going in the right place. And so you're really talking about a handful of people, less or less than that, just to make sure that one, that you're covered from a control perspective, but then also you have adequate coverage to make sure that you're looking at everything you need to from a cash flow perspective, and that you're not missing cash flows, because and Nick can speak to this more properly, but we typically would like to trade at spot, 2-day settle, but there are times where you need to get that there sooner, but there's a cost to do that, right? And there are certain time cutoffs where you simply, we can't send money to Hong Kong right now. They're closed, right? And so you also want to make sure that you're making your commitments in a timely manner and that you have the oversight and you have the eyes on the right place to enable you to do that. Certainly your trading partners will help you as best they can, but when markets are closed, they're closed, right? So having the right coverage and the right eyes on it and making sure you're staffed up to do that, I think all depends on your business, but certainly with, 3 to 4 people, I think you can certainly get a lot done with respect to trading and controls of that trade.
Maybe Nick, maybe I could jump in there for a second. I think what Scott said is really important. I mean, about just how to think about the foreign exchange exposure, and it's like, how do you know as a business, like when is the exposure big enough that you should begin hedging it? And it reminds me of the question that somebody asked Abraham Lincoln, and they said, because Lincoln was such a tall president, they said, how long do you think a man's legs should be? And Lincoln said, long enough to touch the ground. And I think that's true about what level of currency exposure does your firm have before you hedge it, before you begin thinking about managing that risk. And I think that once it becomes important to you, then you need to hedge it. You need to manage it in some fashion, be thinking consciously, willfully of it. And the difference between, I think Scott and Nick are using these the terms that we use in the market, like spot and forward. And as Scott explained, a spot transaction is settled in 2 days, with one exception, maybe 2 exceptions, Canada and Mexico. But typically then you buy the currency on Monday, you get it delivered on Wednesday, more or less. And forwards, it's the same thing, but it's extended in time. For example, you're buying a German machine tool, and you have to pay them half the money up front and another half money in 3 months when you get delivery. So there'd be a spot transaction, and then you'd use a forward transaction to lock in that future price. And that's really what we're talking about here in the capital market. It's not about speculation. It's really about buying insurance. Insurance that the price that you're paying for money, that currency, does not change, that make the transaction you're thinking about unprofitable. And we can have some huge moves in the currencies because they're not backed by gold or silver. You can have very large moves in the currency markets in a short period of time. I mean, when you think about this, I mean, you all have your own profit margins and you all know your own expenses and things like that. But imagine a currency moves 20% in a couple of weeks. No matter where you are in margins, the currency volatility tends to be big enough that it could seriously impact corporate profitability. And so that's why I think that whether it's interest rates or currencies, why I think that it's prudent to think about them, to think about how other people are managing them, and think about how you can apply that to your own business. And I just wanted to give you that color about just thinking about what exposure should you begin thinking about it. And one of the things that Nick had mentioned too, I think we maybe didn't call it this, but we really talk about the democratization of the capital markets, so that small and medium-sized players don't always get such a large short end of the stick. And part of the way to do that is to be more willful in what you're doing, thinking about it. And if you leave it, it's sort of like what happens in the stock market. If you just leave an order to buy Apple stock right now, you just at the market, who knows what you're going to pay for it? So typically, what large investors will do will have a limit. Say Apple stock's trading 122, I'm not going to pay more than 122.5 for it. Those same rules of execution apply in the currency markets too. We could have stops, we can protect. I mean, isn't that really the big difference between what we do in the capital market and gambling? Risk management. We don't take the risk of ruin like gamblers do, like neither do gamblers, but we manage the risk. And as businesses, that's what we have to do. We have to manage the risk. We're bombarded with risks. Who knows what's going to happen when China's going to invade Taiwan, or what Russia's going to do to Europe? But there are some risks that we can manage. Currency risk, currency volatility can be managed. Interest rate risk can be managed. Some commodity risk can be managed. And I think that I'd like to try to go through the list, right? Even for myself, a small businessman, as a head of a household, I think about the risks. How do we manage those risks? Just because it's raining outside, I'm not going to cancel my flood insurance or my fire insurance. And so I think we need to think about our businesses and think about what risks we can manage and what risks we can't. Sorry, Nick.
That's very good. Thanks, Mark. So I want to, before we run out of time, I want to answer that first question a little more. But back, sort of segueing off of what Scott and Mark have said here, larger companies, more market sophisticated companies like Scott's, and even larger companies have the tools and have access to advisory on how to manage risk organically as much as they can. Because really, at the end of the day, a treasurer like Scott wants to access the market as little as possible, because every time you access the market, there's a cost to it. There's a buy and a sell spread, as we were talking about margins and spreads. There is a cost. So you can't avoid the market altogether, especially not if you're a company like Scott's. But if there's something you can do internally, as he talked about, organically through netting and pooling of currency, putting all the different currencies that you trade in all over the world, and even smaller companies. So we try to help smaller companies do some of the same things on a much smaller scale. But so if you can do that and not access the market, then obviously you're saving. Now let's talk about a first time. So I'm gonna mention two. One of the ways, the very typical way that we engage with a client, and I don't think many of our competitors do this, but we'll come in and say, okay, this is a company who's never hedged, let's say, who has payables in Europe. Okay, they're buying product from Europe, and they've never done anything, and maybe they've been paying for them in US dollars, or they've been paying for them in euro, but just as as part of their typical cash flows, they're buying currency and wiring it over multiple times a month or whatever. So what we will do is we get introduced to the company, we get introduced to the Scott there, let's say, and we'll talk to him and say, look, or her, and say, give us a data set of what you've done so far with your current provider. Show us the trades that you've done. We'll take that data, we run it through a model, and we can give them some pretty conservative transparency of what they're paying in the market. Okay, by picking the high and the low of each day they traded and the midpoint, we can give them some sense of what's going on. Oftentimes that surprises them how much they're paying. But back to Mark's comment about retail versus wholesale, and oftentimes if we can at least verify, sometimes we're verifying that they're actually trading at very reasonable margins. Most of the time, we find that there are savings there. So we'll come in on a very basic level and provide. We're not looking to take away their bank relationship, because we don't operate as a bank, but we simply want to provide some transparency and some efficiency. So they might just pull their euro transactions and let us handle those, because we found that there was a very large margin, that they were leaving a lot on the table, quite frankly, in our opinion. All right, so that's the very basic way that we can initially engage with a client, is to provide transparency. The other way, and it's typically to what Melissa was talking about, oftentimes it's capital expenditures, or it might be, a company might be thinking about, well, they're engaging with to make an acquisition in Mexico, but they're talking about it in US dollars because they've never dealt in anything other than US dollars. But so we will help them analyze the benefits and the costs between trading in US dollars does not eliminate your risk. That someone's taking that risk. If you're paying a Mexican seller in US dollars, he's having to take those dollars and convert to Mexican peso, and it's costing him something. He may have hedged it, and that's costing him something potentially, right? So what we try to do is at least make an analysis of that, and if either they're going to trade in Mexican peso to make that acquisition, or they're going to continue to trade in dollars, but we're bringing them some transparency around that. The other might be capital expenditures, where we're first engaged. And we recently it was a new manufacturer in the mid-Atlantic who had a lot of venture capital behind them and a lot of private equity, and they're building a facility. They've got machines coming in. It's a bottling company. They're these new bottling machines that have to be made in different parts of Europe and in Asia. So they had never, and they're not going to be selling anywhere outside the US, at least for the first few years, maybe into Canada in the next 2 or 3 years. So we engaged with him over a year ago. And instead of just paying whatever price, as Marc pointed out, that came up, we helped them solidify that risk and lock into their dollar cost of those machines over the course of 2 years. So they had certainty for 2 years what they were going to be paying. Now, did they take the benefit of a dollar strengthening further? No. Did they? But they were protected against, as Marc pointed out, they had insurance against the downside on the dollar. So their dollar cost, at least they had certainty around the dollar cost, and that was hedging. So those are pretty basic capital expenditures, M&A or acquisitions and dispositions, and of course, spot transactions, cash flows, just payables or receivables. That's where we engage. Oftentimes in the beginning.
Thank you so much, Nick. I appreciate it. And to the panelists, Marc and Scott as well, thank you for your expertise. Thank you for your time. And I will be posting this on EDPNC's YouTube channel. Please reference the chat for contact information. Marc put his contact information in the chat. And Nick, Scott, if you are willing, Nick, is yours in there?
I'm going to do it. I'm going to do it
Yeah,
right
you'll do it
now.
now. Okay, that way people can
Mhm.
grab your contact information off of
Yeah.
the chat. If you have follow-on questions, please reach out to Marc and Nick directly. And if you have ideas for future coffee talks, let me know. I wish everyone a wonderful holiday season. And I think that our next talk will be in the new year in January. So thank you so very much.
Thank you.
Yeah, is yours in there, Nick? I don't want to stop the recording.
I'm trying to put it in. Give me just a moment.
No worries. And those, if you want to stay on the line, I know sometimes we have folks that have a little extra time. And after I stop the recording, if
I'm
panelists have
glad to stay
time
on.
and folks, yeah, you could stay on and chat.
Mhm.